Hi guys, welcome back to the channel. My name is Dave. In 2024, it's been pretty smooth sailing, but early last week, we got some weak ISM manufacturing data. Not good news. Then on top of that, we found out that Warren Buffett has greatly reduced his holding of Apple. So he still owns a lot, but he greatly reduced it. People like that. Then over the weekend, we got this whole Japan carry trade. Ooh, this is not looking good. Toss in some threats in the Middle East, and what do we get come Monday morning? A significant VIX spike. Now, for me, this is kind of exciting stuff, watching this all play out. And I watched a bunch of people that were live streaming the panic. It was quite exciting. So for me, I kind of felt like that kid that watches the trains.
Thank you. 66428. Thanks. Whoa. Full of food and drink.
I guess we all have some sort of strange fetish, and mine might be VIX spikes. I don't really want to know what yours is, but I can probably guess, and it's probably not appropriate for this channel. Anyway, today I want to talk about that VIX spike and how we might be able to take advantage of a VIX spike like what we saw on Monday morning. I also want to talk about SVOL. This is a popular income ETF. It's performed quite well, but we've been waiting for this moment when we have a VIX spike. So I want to see how it held up and talk a little bit about it. I've done a video on it before. I'll link that up above if you want to watch that as well. And I also want to touch on the rebalancing of XLK because it changed significantly, and it's something that I've talked about previously. This is a technology sector ETF. So if that is what you're looking for, please stick around. Whoop. A big driver of options pricing is volatility, and the VIX is our indicator of expected market volatility for the S&P 500. So when the market gets super excited, the VIX spikes like you see in this VIX chart. As I mentioned, for us with a VIX fetish, we have been unsatisfied all year long, just kind of slogging along until we got this big spike on Monday. And for sellers of options, this can make it challenging to find rewarding trades. Now on Monday, as an example, here is a side-by-side of two trades. On the left was a trade I did back in June of this year. If you trade QQQ options, you likely know what this looks like. And it's been a good year for this type of trade, just selling puts, consistently profitable, selling out of the money puts. So with this first trade, what we're looking at is my typical trade this year with QQQ, selling an out of the money put with a low VIX. So back on 6/10, sold one contract of QQQ, 7/5 expiration, which is out 25 days, about 3 to 4 weeks. Stock price was 462.11, and I sold the 442 strike, which is 4.35% below the current stock price. Not that far out of the money, but you know, it's got to drop a little bit. And for that, I collected a premium of $177.32. This has been pretty typical this year. Combine this annualized return of 5.86% with what I can make by mainly staying in cash, and I'm getting a nice little return, right? That's been kind of the play call that I've been using this year. Nothing glamorous, but it can get the job done. Now compare that trade to Monday morning at the open. VIX is elevated. People are panicky, and for option sellers, this can be a good time to make trades, just like it can be a good time to buy stock. Now, I use Fidelity. I know some people had difficulty logging in, but I did not, and I placed my trade soon after the open. On days like this, you can also have option prices that are jumping all over the place. Bid and ask spreads that are just moving like crazy. So be aware and set your limits. But this one is drastically different. So for this trade, 8/5 Monday morning at the open, I sell one contract on QQQ with a 9/6 expiration. That's out about 5 weeks, 4 to 5 weeks. Stock price was 429.16, and I sell a put with a 350 strike. Very conservative, I realize that. Out 18.4% out of the money. Compare that to 4.3% out of the money. Panic has definitely entered the market. If you wanted to be a buyer of puts, you should have done that 2 weeks ago. Hindsight is 20/20, I get it, but you buy it during these low VIX moments. If you want to be a seller of option premium, you do it during a spike, or you do it during elevated VIX. You can just see the impact here. So 18% out of the money, and for that I collected a premium of $583.47 in comparison to that $177.32 being this far out of the money. Dramatic difference with elevated VIX Monday morning. So that was an annualized return of about 18%. You're going to see my dollars that I closed it with here. I closed it about 24 hours later, but more on that in a moment. And here's a screenshot about 90 minutes later, around 11 a.m. as the VIX started to calm down. QQQ had not moved more than a buck or two, but 46% of the premium had already evaporated. The cost to close would have been about $315 by 11 a.m. And I ended up closing this trade the next day for $89.51. So this is just a great example of how distorted option pricing can get with a VIX spike. Of course, this just offset the significant unrealized losses from being a general market participant during this same exact period, but more on that when we talk about XLK. By the way, I am branching out a little bit from YouTube, and I'm starting up my own website called MyWealthAdventure.com. It's about My Wealth Adventure and yours as well. So if you really like this content and you want even more, head on over there and sign up. It's free to sign up. It's just a newsletter and me gathering some data to find out exactly what my audience actually enjoys to hear and learn about. So head on over there and check out MyWealthAdventure.com. Thank you so much. I also reached out to the folks at Simplify ETFs on Monday about SVOL because I was curious. Now, this is a popular alternative income ETF that I have reviewed before, and I'll link that video above for more information on SVOL. But the folks at Simplify were kind enough to share some information with me, and I hope that I can do a follow-up with them in the near future on SVOL and this VIX Spike. So if that sounds interesting, like and subscribe. But SVOL, as the name implies, shorts volatility. And this has been working great over the last 2 years. So people that own SVOL have enjoyed a smooth ride, collecting about 16 to 17% in annual distribution. So it's doing quite well for income investors. However, the one major concern with SVOL is a VIX spike, something that would change the VIX futures curve from contango to backwardation. Now, these are two of my favorite cocktail party words. Gets everybody excited, right? But all it really means is that the typical VIX futures curve is upward sloping as you move away from the spot price, which is the price today. SVOL knows this, so they sell VIX futures way out here in the future, and when they get closer to the spot VIX, right around here, they sell the futures, making money for the fund. Glorious. However, what can happen is something called backwardation, which typically occurs when the spot VIX index spikes and it drives the curve up. Now, the contracts they sold way out here could really damage the fund as time ticks away. When the day comes to buy back the contracts, it could be a substantial loss. So for that reason, they also buy some VIX call options because in the past, similar funds imploded. They imploded so gloriously that the event even got its own name, Volmageddon. So anyway, SVOL addresses that concern with these call options. And for maybe the first time since SVOL came on the scene, these purchase call options started to kick into action on Monday, according to the people over at Simplify. And I kind of pictured, Simplify as a scene out of Wolf of Wall Street for just a brief moment.
Oh, today it is trading at 36 and a half. Mr. Buck.
And I'm sure in the middle of all that, they really appreciated getting my email asking, bugging them about this. But to summarize what I was told, the hedges, meaning the purchase calls, were helping, but they would like to keep them in place and roll as needed to maintain coverage. They still need them as insurance. However, if they went in the money, they would consider closing some of the contracts. Now, looking back here, since the 1st of August, we have seen SVOL drop around 10.5% to a low of around $20 on Monday. However, it has bounced off that low and it currently sits at $21.94, which is only about 2%, a 2% decline for this month. And for comparison's sake, the S&P is down around 3% this month. So we'll have to see if the distribution is affected when it is announced near the end of the month. For those that are curious, I do own SVOL, but I do treat it as an alternative investment. That is, I keep the position size small in my portfolio. Finally, let's talk about XLK. This is the Technology Select Sector ETF from Spider. And let's start with the fact that I own XLK. I've even done a portfolio build with XLK, XLV, which is healthcare, and SCHD. I'll link that video above if you're curious. Yeah, I think XLK is a decent way to buy tech stocks, and performance has been great over the last 10 years, along with many other tech-focused funds. However, XLK recently went through a major rebalancing back on June 21st it significantly changed the fund, much more so than I expected until I took the time to look. And why did I take a look? Well, because the market correction drove down XLK along with most everything else, and I had several sold puts, and my sold puts were assigned Monday night. In this case, all 500 shares or $115,000 worth of XLK at a $230 per share price. Now, I did try to rule out my position on Monday, but one weakness of something like XLK is that volume and open interest are relatively low, and on a day like Monday, well, bid and ask spreads were quite wide. So for put buyers, the best option is sometimes just to call your broker and put the stock to the put sellers. You were right, you made a bunch of money, let's go put it to them, settle it, make it easy. So I have already sold calls against this position. I think it will end up being a positive for me in the long run, but I'm currently down a rather large number. And now I own a bunch of Microsoft and Apple, right? Or do I? Well, I do, but this crazy rebalance really changed the fund. So this slide here, this is before the rebalance. Microsoft was 22%. Again, this is back in June. Apple was about 22%. NVIDIA was around 6%. After the rebalance on June 21st, because of some old rule in the index, we now have this, right? Microsoft around 22%, NVIDIA near 20%, and Apple at 4.5%. This is a dramatic change, to say the least. And the main driver here is the surge in the market cap of NVIDIA. And this caused them to sell about $11 billion of Apple, which, by the way, is nothing compared to what Berkshire has dumped recently, and also to purchase about $10 billion of NVIDIA. Needless to say, this is a significant change that is worth mentioning for XLK. So XLK rebalancing, I know, so exciting. What could possibly be next? Maybe 66428.
Thank you! 66428, thanks! Whoa! Oh. Full of food and drink.
Anyway, thank you so much for watching. I appreciate it. Like and subscribe if you like this type of content. Check out MyWealthAdventure if you get a chance and you like this type of content as well. And we'll see you next time. Have a great night. Whoop.